Hello, good evening. Tonight we're going to talk a little bit about tax season and do you need an IRA for tax season? If we haven't met before, my name is Monica Brito with thatsimplelife.com, and this is my husband David, and he's kind of our financial expert around here. So he's going to talk to us a little bit about whether or not we should have an IRA. I know that's a concern, especially for people who are self-employed, but honestly, I don't know how all that stuff works.
People on the street stop me all the time and ask me about that. So tonight we're going to talk about an IRA. Is it for you? It's tax time. Everyone's talking about funding either an IRA, Roth IRA, even regular work or employer-sponsored retirement plans. So we're going to IRAs. First of all, traditional and Roth. So there are two types of IRAs. Basically, an IRA is an individual retirement plan. You're allowed to contribute on an after-tax basis, which means you have to write a check for it. Basically, the traditional IRA, it may be deductible. So you can write that off on your taxes. Normally these are good for people who are generally not covered by an employer's retirement plan. So if you work for a mom and pop place, or maybe you work part-time and you're not eligible for full-time benefits up to and including a retirement plan, take a look at an IRA. It might be able to save you some money on taxes based on your income. So and some of the limits depends on your age. So if you're under 50, generally you can put in $5,500 a year. 50 and over, it's $6,500 a year. So again, these are contributed on an after-tax basis. The other thing that you can do or consider is fund a Roth IRA. So Roth IRAs are a little bit different animal. You still fund it with an after-tax contribution, but there's no deduction at any income level. So you can't write it off on your taxes for a Roth IRA. But these funds grow tax deferred. The real key to the Roth, though, is when you pull it out at retirement, assuming you're 59 and a half and older and had the funds in there for 5 years or longer.
I wouldn't know anybody that age.
Tax-free. So the Roth IRA has a really good benefit of pulling out funds tax-free. Granted, the real way to make this work is if you fund it consistently. People who fund it, once or twice, or put $1,000 one year and don't fund it for 3 years, generally you're not going to have that much.
It's not going to do anything.
Yeah, it's not going to do much for you. Maybe you have a vacation fund that you can take out when you retire tax-free. But if you really want to supplement retirement income and you have several years to make this work, then a Roth, you would definitely want to consider that.
So you don't have to be self-employed to get an IRA?
No, but there is a simplified employee pension or SEP IRA, which you could open up if you're a business owner or you're self-employed. So generally allows you to contribute up to $50,000. So it's a lot of money, but you can, if you owe taxes like 10 grand a year all the time, then you could consider funding a SEP IRA and have that deducted off your taxes up to some limits. So may want to consider a tax professional for that, but I could definitely help you answer any questions that you may have for that. So again, the IRAs, basically, you have the traditional one, which is after-tax contributions. You can deduct that up to certain income levels. When you pull that out at retirement, it is taxable. So the Roth IRA, after-tax contributions, there's no deductions at any income levels there. When you pull that out, it's tax-free. So it's a good supplement for you if you wanted to get some tax-free income. The other thing you can do is, obviously, if you're covered by an employer's retirement plan, like a 401k, 457, 403bs, they're all kind of the same type of retirement plan. But you can have higher limits with those. So generally, if you're under 50, you can contribute $18,500. 50 and over is $24,500. It's a lot. It's a little over, generally $1,000 a paycheck, a little bit more than that, but for the maximum 50 and over, but allows you to deduct every dollar up to that. So it gives you a huge tax break, saving money on retirement. But again, those are the IRS maximum limits. So the other thing too with the 401k is at your job you may have an employer match. So take advantage of that match. It's literally free money. So invite you to all take a look at your retirement plans at least every year. See if you could increase contributions, or if you have a match, contribute up to the match level and help you save some money.
I know you're all about that.
Yep. And kind of leads into another topic. We're going to talk about this later on in the month, though, but what to do with your 401k. So if you have a 401k from a previous job, you could also roll that over into an IRA. So it gives you some flexibility, and you could always have the funds directed any way you want, which is really good with the IRA. You could keep those funds growing tax deferred. The advantage of you could control those investments. You could even place those accounts into different types of investments. So generally your employer's plan, maybe you were invested in a stock fund, goes up and down with the stock market, but there are other types of investments where you can control those investments. There's even no risk accounts, even accounts where your principal's guaranteed. So if you're looking at the stable, or you want to cut investment risk, that might be a good option for you as well. So message us if you have any questions about those type of accounts as well. We can help you with that.
So in review, what are the 3 different types of IRAs?
Well, 2 types actually.
Oh, okay.
So it's a traditional IRA. Well, there's a rollover IRA. So the traditional or contributory IRA, you could contribute every year.
So who exactly, specifically would that be for again?
Generally for people who are not covered by an employer's retirement plan.
So you work for like a small business?
Yeah, or maybe you're a part-time employee with no retirement benefits. So you'd be able to contribute up to $5,500 or $6,500. Also for people who max out their employer's retirement plan, may contribute to an IRA in addition to your employer's plan. That's a lot of money though. So
yeah.
But
and then the rollover thing, what did you?
Okay, so then we covered the Roth, which is the account that you fund and then you pull it out tax-free at retirement. So the Roth is a tax-free
and who's
vehicle.
that for?
Anyone who wants to supplement and have tax-free income. So knowing that it's not deductible. There are certain limits though. So generally for the Roth IRA, if you're single, making less than $118,000, you could contribute to that. But if you make like 120 grand or more and you're single, you may not be able to deduct or contribute, the whole $5,500. It starts to scale down. So high income earners with a Roth generally doesn't work very well, but it covers most people. But that's why you should talk to a professional if you have any questions. And then, of course, the third one is the IRA rollover. So what that means is the monies came from a different retirement plan, and it's just under the tax-deferred umbrella. So it's considered a rollover.
And why is that beneficial? Like, why would somebody get that?
So let's say you have a retirement plan from a job you left like 5 or 10 years ago, and you keep getting your statements.
Just like sitting there.
You're just kind of sitting there. Obviously, you're not contributing to it, but you could also roll it over to an IRA, and you could direct the investments however you want.
So you have more control over it.
Yeah, more control instead of.
Because I was about to call the kids over here because you're speaking Chinese
instead
to me. The kids can translate for us.
Yeah, instead of in your former employer's retirement plan, whatever they offered you, you would still be part of that. Well, you can call your own shots with the individual retirement account and invest in whatever you want. Like I said, there's even accounts that also guarantee principal where you don't see your value going up and down with the stock market. So it kind of scales down risk. So really depends on what your needs are. And we can help you with that.
And that's why David and I make a good team, because I have no clue what he was just talking about. But if you have any questions about real estate, mortgages, getting out of debt, budget planning, getting organized, your calendar in order, I'm your gal. But this guy is your finance guru over here. So anything else?
That's it.
Awesome.
We'll
get on with our night. No drinky poo tonight?
No,
we're going to be good?
Yeah,
okay.
We'll probably be good tonight.
All right. Well, thank you so much for joining us, and we will see you. Actually, I take that back. I will not see you next week. You will see David next week, and David will be talking about life insurance next week. Who needs life insurance, right? Something like that?
Something like that.
Okay, another subject I know nothing about. Anyway,
basics.
Have a good night. Ciao.